Hi, welcome to a special market update. With the election behind us, we have some interesting things to go over. A lot of annotation, a lot of arrows and stuff on this chart. So let me go through what I'm looking at here. This is the daily cash S&P, and for those who viewed our last highlight, we were talking about, and that was about a week or two ago, what we talked about when the market broke this prior support area. See these blue lines over here? And once the market broke the prior support, we were talking about the old support area, which is highlighted with the red arrow. Once broken on a close, we were looking at it becoming a resistance area, and you can see how the market tried to get above it, but really couldn't hold above it on a closing basis. So we were looking at old support becoming resistance, which indeed did turn out to be the scenario. Now what's happening is, I'm doing this recording, by the way, on Thursday, mid-morning New York time. And so yesterday, i.e. on Wednesday, the market broke a support area based on the lows from August, mid and late August. And it looks like we're pushing a little above it, at least based on the action so far early in the day. So if we can close above, I'd say 1400, I would view this and the lows yesterday as a first support area. But what I'm looking at here is this is a descending triangle. So we have horizontal support and lower highs. And what you could do is take the height of the triangle, which I did with this vertical two-headed arrow, and subtract it from the breakdown point. So our target is really a little closer to 1375 shorter term. But let me show you something really interesting on the weekly chart in the S&P. And don't let all these numbers scare you. These are Fibonacci retracements, and I'm not going to go over exactly what it is. Many of you are familiar with that. And it's more popular in the Forex market, but it's essentially a way of taking rallies or sell-offs and figuring out percentages of retracements where you could find support or resistance. So, for example, if you have a rally, let's say 100 points, and you may look for a 50% retracement. So you look for a rally. Let's say the market goes from 100 to 200. You'd look for a potential support area at a 50% retracement at 150. So popular Fibonacci retracements numbers are 61.8%, 50%, and 38.2%. Let me show you something interesting in the weekly charts here in the S&P. So here we had a rally, and it may be off by a few points because I did this fairly quickly, but essentially took the low from September to the high that we had here, whatever this was, maybe October, and it looked like right around a 61.8% retracement is where the sell-off stalled. Same scenario. I went from the low here to the high here, all right, and right around a 61.8% retracement. Notice where the market found support. So in both these most recent important rallies, from here and from here, in both cases, the 61.8% held as a potential support area. So if that analogy continues going forward, going from the low here to the high here again, I probably didn't make an exact number. This should have been up on the top here, but kind of ballparking it, we could look for a 61.8% correction if the analogy holds as it did the last two times for any sustainable sell-offs. In other words, any sell-offs to find longer-term support down anywhere from around 1340 to maybe around the 1350 area, using around a 61.8% retracement. In Forex, we're in a bear channel, and by the way, these are parallel lines. Sometimes when you have channels, this is a downward sloping line, and I just made a parallel line over here, so you can see we're in a bear channel. And as of yesterday, that is on Wednesday, the market did break a support area shown by these dual red lines, a support zone. And what's going to happen is, like the S&P, this old support area may now become resistance around 128. I would actually use the high over here, maybe around 128.50, as an area to say if the market closes above it, that's a bullish action. That would be bullish action. But for now, I think the bears are in control, and unless we get a close above these highs over here, I would take the height of the trading range from around 128 to 132, that's 400 pips, and get a downside target of 124, which, by the way, are the lows back in late August.